because of the US dominance over really the last decade versus other global equity markets, a lot of our clients find themselves even more overweight than they think they are just based on performance alone. A lot of exposure to the technology sector and US equities in general. And so I think what we want to do is maintain the US exposure, but look to trim back some of that overweight into places like Europe and Japan. And so now more than ever, we think it really makes sense to have a global allocation to equities. And that's something that I think a lot of our clients don't have enough of because the US has just been so dominant for so long. Again, we're not giving up on the US, but I think for clients that have avoided Europe in the recent past, given all the uncertainty and generally slower growth in Europe, there's a valuation gap of about 25 to even 30% versus the US that I think creates an attractive opportunity to add European equities to benefit from potential rebound in that valuation gap, but also to benefit from a potential strengthening of the euro versus the dollar from here. So trimming back the US overweight a bit in favor of Europe and Japan. And then sector-wise, we're really looking at kind of large, dominant, quality global companies that can benefit from selling into different geographies. So looking for high quality European global multinationals that can do business around the world.
So how would you divide the portfolio in terms of percentage allocated to European equities versus US equities versus a fixed income, and in what markets versus gold? So give us a breakdown in percentage terms.
Yeah, that's a tough question to answer because every client is different in terms of their objectives. And, we tend to start with what we call a plan, a goals-based plan. So, what is your appetite for volatility and sort of what are your return expectations? And so that will dictate how much equity versus fixed income you own in a portfolio. Generally speaking, our balanced portfolios are roughly 60% global equity and 40% global fixed income. And I think we do see good opportunity both in equity and fixed income this year because, again, we're calling for lower interest rates. And, the starting point also allows fixed income to serve as that portfolio protection, that insurance that you're going to have if our core view of slow, steady global growth doesn't play out. So I think a balanced portfolio is a great starting point. Within the balance, you want to have global equity. Currently, right now, we are neutral US and neutral Europe. I realize that doesn't mean a lot, but essentially it means that you need to own both Europe and US equities, whereas a lot of clients, based on the recent past, tend to own far too much US and US technology only. So 60-40, I think, is a great starting point. Of course, for the clients that have higher return objectives, the equity allocation will move higher. And for clients looking for more stability and income, we see a lot of opportunity in fixed income markets right now, where you can get really attractive yields and benefit from some potential share appreciation as interest rates come down.
Fixed income in which markets? Like which, is it Asia or Europe, US?
Primarily US, but also we do see some European fixed income opportunities. Interest rates right now are the highest in the US, and we think that offers a good opportunity to lock in that yield. And not just for the next 3 to 6 to 12 months, where we see a lot of clients gravitating towards short-term fixed income or even fiduciary deposits with banks because the rates are very attractive. I think the opportunities to really think out the next few years and extend that duration a bit. And so we're really advising clients to start to lock that in by buying bonds or fixed income in both US and Europe that have a duration of maybe 3 or 4 or even 5 years, where you're essentially locking in that rate for the longer term. So that's a big part of what we're doing, both in the managed portfolios, but also for clients on an advisory basis, is helping them think about their income needs, not just in the next 3 to 6 months, but really the next 3 to 5 years.